Coming up on Money Life.
Remember the old adage, right? Markets climb a wall of worry. I'm not going to say it's climbing an Everest of worry. Maybe we're climbing, K2 or Denali or something of that nature. But it's climbing quite the huge wall of worry, considering where we are in this conversation.
That's Steve Sosnick, Chief Strategist at Interactive Brokers. And in an expansive big interview today, he will talk about how we might be climbing that wall of worry, but we might still have a lot to actually worry about. But up first, Todd Rosenbluth, head of research at Vetify, has a portfolio diversifier as his ETF for the week. And then I will answer a listener's question about why I seem to be more worried than the experts who appear on this show about the possibilities for trouble in the private credit markets.
Let's go, Chuck.
Oh yeah, let's go indeed. We are off to the races. This is Money Life for May the 22nd. I'm your host, Chuck Jaffe. Thank you so much for joining me. We have a great show planned and executed for you. And I'm going to try to start this with a reminder that I probably should give you at the end of the show, but I'm afraid I'll forget, which is we tape the interviews before we tape this part of the show. So Steve Sosnick talks at the end of that interview about how he thinks there is trouble coming. He makes a case that things could be pretty ugly in the next 6 months between now and when I talk to him again. And I kind of made a joke with him about, I'm not going to be looking forward to that conversation. And when I immediately finished the interview, what I thought I should say, and that's why I'm saying it now because I want you to hear it up front, is no matter what happens, I'm going to be really good and really happy when I talk to Steve the next time. Not because I love talking to Steve, that's a reason, but because of something else, which is, what's going to happen in the next 6 months? Well, I can't tell you what the market's going to do. But as I've said on this show before, I'm turning into the mythical creature that I most want to be. No, I'm not becoming a dragon. I'm becoming a grandfather. Admittedly, it's not happening until August. Thank you for those of you who have asked, etc. My daughter Whitney and her husband Greg, they are expecting a boy in the summer. I'm super excited about it. And yeah, in the big scheme of things, you have to remember that while we call the show Money Life, that's because life money doesn't roll off the tongue. Life comes first. So in the immediate, I heard Steve say it and I thought, oh, man, sets us up for the next months being terrible. I am pretty optimistic that the next 6 months will be great. And then I won't get to the end of it and go, all I can focus on is my portfolio. And that is an important thing because you don't just want to be focused on your portfolio. We say every day, the best thing you can do for your money is not worry too much about it. Steve makes the point, what we've seen is a good stress test. I've been saying it as well. Look at your portfolio, make those changes. Gail and I have not followed through yet to make the changes in her portfolio. That's actually something we're likely to do in the next 2 days because we've kind of tried to build some time so that we can do that as she is able to look at her portfolio and say, I want less volatility. And I'm looking at, is there anything appropriate for me to make a change on as well? I probably won't make any changes, but I might. I might take a look and see if there's something I want to do or I'm going to check my asset allocation and just make sure it's where I want it to be for a man of my age and my prospects and everything else. That's a solid thing to do in this market. There are plenty of great talking points in this interview with Steve Sosnick. One area that we didn't get into a lot was private credit, which does seem to come up a ton these days. And so I'm also answering a question today that looks at private credit and specifically it's a really good question. I say all the time, you guys make me better at my job, but I hope that you're becoming better investors. And the way that Malcolm and Bradenton, who wrote me, is becoming a better investor is he's ready to make a private credit investment because he's heard it talked about a lot on the show, but he's also heard me ask questions about it, saying that I'm worried. And he really wants to get an understanding of why I'm worried because that will help him decide if he's worried. And that is exactly how we want you to use the show. Use it to hear the things that are going to help you say, I've got the courage of my convictions. I am ready to take this chance. I'm ready to diversify that way. Or no, I don't want to go in that direction. I don't like enough what I've heard. Make those decisions, but own those decisions. That's what we hope you're going to do. So that's what we've got. I'd love to hear from you. Chuck at moneylifeshow.com. Remember to stick around to the end of the show. We have a contest coming today. That's why I figured I'd need to make that point about what Steve was saying up front and not later, because I'll probably get tied up in the contest. But Chuck at moneylifeshow.com is how you reach me. Right now, however, Money Life is going to reach you. Steve Sosnick's here. I'm answering a question. But up next, Todd Rosenbluth, head of research at Verify, kicks us off with the ETF of the week.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
One fund on point for today. The expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth, the head of research at Verify. And if you go to verify.com, you're going to find all the tools and research you need to make yourself a savvier, smarter investor in ETFs. Todd Rosenbluth, it's great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
The Aberdeen Bloomberg All Commodity Longer Dated Strategy K1 Free ETF, BCI.
BCI, the Aberdeen Bloomberg All Commodity Strategy K1 Free ETF. It's a mouthful, but I think the most important word in there that explains why it's ETF of the week is going to be commodities. So why this fund in this structure now?
You're right. There's a lot of words here. We'll try to break down as many of them as appropriate, but commodities is the area of focus. We saw last week consumers are more concerned about inflation than I think on record. The consumer sentiment, inflation expectations spiked because of the fears of tariff. So we have not seen inflation spike yet, but consumers are expecting it. And thus, we want to make sure that consumers, or ETF consumers, are making sure they have exposure to commodities within their portfolio. Commodities like gold and energy and agricultural products are less sensitive. You can actually benefit from what's going on in the macroeconomic environment through a commodity slice within your portfolio. And this Aberdeen product, which is index-based, relatively cheap, to me is like the S&P 500 for commodities. It's well diversified, it's well structured, it's done in a smart way. Aberdeen is a leader in the commodity space. It has a lot of positive characteristics.
It does. One is K1 free. That's about taxes, but explain why K1 free is legitimately important to an investor who's getting commodities.
So if you're investing in commodities or an ETF that uses futures contracts, there's different level of tax implications, and it just becomes harder. You get taxed for things you didn't fully appreciate, and it's different than every other ETF. So we've seen a number of ETFs that are K1 free. It means your tax status or tax situation is like every other ETF you'd have within your portfolio. So it's just simple. You pay taxes when you sell, and if you make gains on it, as opposed to taxes throughout the year based on what's going on with the futures contracts.
As for commodities themselves, there are tons of commodity funds, and you can make it that, like, I'll buy corn or I'll buy oil or I'll do something direct. Why broad-based versus targeted in an environment where it seems like there are a few industries you might want to target?
So we've seen gold be a stronger performer this year, and individualized gold ETFs, spot gold, let alone futures-based gold ETFs. I think there's one or two that are out there. Those are outperforming what we've seen within agriculture or we've seen in the energy space, but that won't always be the case. So we're big believers in diversification. This ETF, BCI, has roughly a third in energy, roughly a third in agriculture, and roughly a third within metals, whether that's precious metals like gold or industrial metals. So you're getting that risk and reward spread around. The same way that many people believe technology is going to be a leader within the markets, but they own the S&P 500. Technology is the largest of the weighting, but you get that diversification in healthcare or consumer staples or financials to have some value-oriented stocks within your portfolio. We think BCI gives you that core, reasonably priced, a building block product to have within your asset allocation strategy.
Of late, Todd, the ETFs of the week have all been actively managed ETFs. They have all been, let's get into a space and not do it with indexing. This is an index-based strategy. So why here do you want the index, or is it you want the investment and right now you like the index, but we could do this again at some point and you'd say, now in commodities, I want active.
So if you remember, you probably do, and the audience probably does, that about a month or so ago, a little over a month ago, we talked about an active version of commodities. I want to give investors the variety of products to consider. Is this better than active? Well, it depends upon which active fund we're talking about. The index is going to be the average, or is going to be representative of the market. Sometimes that's a good thing. Sometimes a fund or manager is going to be quite good at seeing what's going to happen next. Low cost index based ETFs still remain the dominant part of the ETF marketplace, even though active ETFs have been gaining market share. If you want to have it simple and have a strategic position and not have to worry about whether the manager is doing well or whether the manager leaves, this index-based ETF is a great way of getting core commodity diversified exposure.
Is it sufficient to be all of your commodity exposure? Or if you're building a portfolio, would you at some point say, I want the index and the active?
So you certainly could have a combination of an active and a passive based approach. I'm trying to remember which fund. I think we talked about Neuberger Berman, might have been the firm that we talked about it that had an active commodity strategy that we talked about. You also could use this BCI, this Aberdeen ETF, as the core and then overweight exposure towards one of those areas, whether that's precious metals and gold in particular, or agriculture, or energy, the same way that people are doing that within the equity or the fixed income space. You have the S&P 500 or you have the Bloomberg Barclays Ag as your core, and then you augment it with an active ETF or a more targeted product. But BCI is a great starting point for someone who has no commodity exposure within their portfolio.
And for someone who has no commodity exposure and is considering BCI as a possibility, how much of a portfolio you're willing to let commodities be? Because that is a distinct, acquired taste. It fits into the alternative side of things, but it's not usually something somebody's go, yeah, let's just make that my entirety of alternatives.
Correct. So we've seen, and I'll go to the default of people have a 60-40 equity fixed income portfolio or a 70-30 equity fixed income. We've increasingly seen advisors, investors have roughly 5 to 10% that is something that's not equity or fixed income. And that can be commodities. That can certainly be Bitcoin. I think we've talked about Bitcoin as an alternative. There's other ways. I believe we talked about a hedge fund like strategy a few weeks ago. This is all going to make up or potentially make up that 10% slice of your portfolio. So equities and fixed income should be a larger weighting, but this ETF, BCI, and commodities in general offers diversification. Commodities tend to zag when the equity and fixed income markets zig. And so you want to get that alternative approach to a portfolio to balance things out.
It's BCI, the Aberdeen Bloomberg All Commodities Strategy K1 Free ETF, the ETF of the week from Todd Rosenbluth at VettaFi. Todd, great stuff. See you again next week.
I'll see you next week, Chuck.
Todd Rosenbluth is head of research at VettaFi. Go to VettaFi.com for more information. Check out their research on your favorite ETFs. Todd, of course, is here to start us off every Thursday, and we are just getting started on the May 22nd edition of Money Life. Later, I will talk with Steve Sosnick from Interactive Brokers. That will be our big interview. But up next, I'm going to answer an audience member's question about private credit and investing in private credit and why I sometimes worry about it. That's coming up when we come back in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Anybody have any questions?
Any questions?
I'd like to ask you some questions.
I have a question.
Oh, you can ask questions.
I should have all the answers for you in about 10 minutes.
Well, I don't know for sure it'll be all the answers, but I'm going to certainly answer the question I got from Malcolm in Bradenton, Florida, that is on a subject that comes up on this show a lot. It comes up on this show because we're talking about where people might want to put their money, and this is an answer we get from a lot of investment strategists, professional money managers, etc. So I'd love to get it if you've got questions like this one or anything else.
I'm sorry, but all questions must be submitted in writing.
You do have to submit the question in writing. So send it to chuck@moneylifeshow.com, and hopefully we'll get it into a show soon. Or maybe I'll answer it privately, which also does happen. This question, again, is from Malcolm in Bradenton, who writes, Chuck, private credit comes up a lot on your show these days, and it seems like every time it does, you ask about the possibility that there will be a blow-up or a big problem. Most of the people you talk to don't think there will be that problem, but you seem worried. I'm looking at investing in private credit through either a closed-end fund or a BDC. And he put parenthetically, same thing, I guess. Before I do, I really want to understand what you're so worried about. So what am I missing, or why are you worried when the money managers aren't? Well, Malcolm, always good to hear from you. Thanks so much for the question. First, let me go back to that parenthetical thing. While we lump business development companies in with closed-end funds, they are different vehicles. We've explained the differences on the Navigator, and there are plenty of money managers who do not consider them to be the same thing. But they are similar, which is why John Cole Scott and the Active Investment Company Alliance sponsors the Navigator. That's why they lump them together, why we also put them together. You do want to make sure you understand the differences in structures here. Having cleared that up, let's dive into private credit and start with a little explanation for why it's become so popular after I point out Chris Zaccarelli on this show a day ago said he has some of the same concerns I do in terms of what could happen with private credit. So he talked about it, how they use it, etc. But I don't think most of the folks who come on this show are going to say anything terrible about it because they're talking their book. And you have to ask them the question. You kind of want to take where they come at it with some serious, okay, are you ignoring the blind spots or do you think they're there? So let's dive into private credit and start with an explanation for why it's now so popular. Private credit would have been considered the Wild West of the financial world prior to the Great Financial Crisis in 2008. Back then, it was mostly distressed debt and financing. But in light of the global financial crisis, there were new banking regulations that encouraged banks to de-emphasize traditional corporate lending. And that led to significant changes in the financing markets because asset managers recognized the need for capital and the opportunities that created. So they dramatically stepped up direct lending at the same time that traditional banks were doing less corporate lending, especially to middle market companies and smaller businesses. That trend is likely to continue as there's going to be trillions of dollars cut out of the bank lending pool, which will make private credit more viable as a source of replacement capital. A lot of new investment strategies and styles have come out of the expansion of the industry, and collectively they represent the private debt market, which is now estimated by a number of different sources at having over $1.7 trillion in assets. So before we get to why I'm so concerned, let's talk about why wealth managers and financial advisors like private credit. Here's a few reasons. One, the loans have a contractual maturity date. They typically have collateral to back them, and they're senior to equity in a company's capital structure, which means you know when they're getting paid. They get paid first. That gives you downside protection compared to private equity and venture capital investments. Next, illiquid fund structures allow managers to be more selective with the capital they deploy. Most assets in private credit markets are held in traditional illiquid and non-traded or semi-liquid fund structures, Well, when something's illiquid, the managers can be patient because they don't face day-to-day pressure for pricing the fund, nor do they face redemptions on any regular basis from investors who are unhappy with performance. And there are certain things that would be really difficult to hold if you might be facing redemptions that you can own in these structures because you know that the money's going to have to be patient. And yes, patient is a good thing, but there is a price that potentially comes with it. Next, and perhaps most importantly for a lot of you, private credit historically has outperformed public leveraged finance asset classes like junk bonds or high yield bonds and bank loans. Depending on credit quality, private credit spreads tend to be 200 basis points to 600 basis points. That's 2% to 6% higher than public investments of the same genre. So in other words, if you're considering high yield bonds, you're looking at junk bonds, if you instead go with private credit, you could expect private credit in the same space to basically deliver an additional 2 percentage points a year, up to 6 percentage points a year, depending on how well it's managed. And then the last thing is because the investment is private and it isn't priced to be traded every day, it's typically much less volatile than publicly traded high yield or other bonds. So now let's turn this around and get to my concerns. First, I'm a skeptic. It's my job, it's my nature, but it's also because I've seen many times over the years, as I've said on the show, when something that is illiquid gets popular, the money flows in. Eventually, there's enough demand that the money flows into things that are of lesser quality because everybody's so anxious to get to whatever they're buying that they'll take a little something less. It's kind of like saying, hey, I want to invest in AI, but there's a difference between the big, well-known AI companies and the next guy who just has an AI idea that might work out or it might bomb. So once the money flows into things that are of lesser quality, if there's a problem, which eventually does tend to happen, the entire asset class will suffer while the pros reconsider what they're doing and try to figure it out. It's akin to when we had subprime mortgages. Some of the subprime mortgages and the start of all the things that created the subprime mortgage housing crisis, great financial crisis, whatever you want to call it, back in 2008, well, it wasn't, oh, you're doing subprime lending, it's automatically terrible. It was, once they kept extending, they went to the wrong place. Once they had bad quality, now you had to look at everything. The whole thing cratered. So in a nutshell, my concerns amount to the speed of growth of the private credit market and whether managers can continue to selectively deploy capital while mitigating the downside risk. Secondarily, how well can we as individual investors assess the relative values of private credit compared to publicly traded credit markets? Like, if you want that extra 2 to 6%, are you sure you're getting it? Like, do you know that you're going to get that payback, that you're taking the appropriate risk and that it will deliver? And by the way, how can we determine who does it well and which managers we want to invest with? Because this is an area where manager risk is very real. Get the wrong guy, get the person who doesn't maybe have as much power, the person who's got a flood of assets, but they can't make the same deals that the giants can or what have you. And you could be looking at the people who are maybe stretching. And then what happens in the event of potential trouble? Like, can you get your money out and all the rest? So now let's go to the blow up, potential blow ups that I keep talking about. Say you have a fund or a BDC or a firm that invests in private debt. Effectively, they say that the value of the loan they made is stable so long as the interest is being paid. So if they made an investment of, say, $100 million, they consider it worth $100 million every day. They scoop the interest, but the underlying value of the shares is that $100 million. But what happens if the borrower has a problem, if there's a default or a potential default? If all of a sudden, for whatever reason, the lender, the company you've invested in, is looking at a loan that is greatly devalued because you can't be sure you're going to get paid back. So let's say, just for easy math, that the market decides the debt is worth 50 cents on the dollar. The pricing on that liquid investment gets cut in half. Now, it's just one thing that a fund might own or what have you. So if they have $1 billion out there, well, 100 million is 10% of that. 10% of that portfolio just got cut in half, right? So you just watched your investment take a 5% haircut. But again, if that were to happen, it might make a lot of the other things there have to be repriced as well, because they're not priced every day, and they're pricing. It's not very clear exactly how things get priced. So while everyone is questioning the value of everything in the portfolio, that can hurt the value of other debt deals that the lender has made. It also is going to affect the entire industry. But here's the other side of that. You just watch, if that gets marked down again to zero, they say, oh, it's worthless. Now you've got a 10% loss, but can you get your money out? And if you can't get your money out, or people are rushing to the exits, or you can only get part of your money out, and those are things that happen in interval funds and illiquid investments, et cetera, you don't know what it's going to be worth when you get your money back. And if you think it's hard to ride out a general market downturn, imagine how you'd feel if you were only able to get out after the value of your investments gets crushed. And oh, by the way, you only have a short time to decide whether to stay or go because you have a window. It's really hard to be a patient investor that way. Now, is one of these blowups going to happen for sure? Oh, I hope not. But I suspect it will happen, with the big question being whether it's going to be some quirky, oddball little fund that few investors have heard of, that doesn't have a big impact, and it'll just kind of be, okay, it happened to this guy, but everybody else go clean things up and shake things out, make more adjustments if you need to, etc. But the question is also, will it shake the public's confidence in all the players? If it does, all of the loans can be devalued the same way you saw subprime mortgages and subprime lending. The entire genre got devalued. So that, in a nutshell, is why I'm worried. And it's why you should be cautious. Learn what you can about your lenders, whether it's a fund manager, a BDC, or if you're doing it directly. Make sure you're comfortable with what you're getting. That higher return than the public stuff, that's a premium for giving up day-to-day liquidity. Make sure you're getting paid enough that you feel okay giving up day-to-day liquidity. Consider whether maybe what you want instead is one of those ETFs that invests in private debt. There aren't many of them, but it's an alternative. And don't take my skepticism as somehow saying, don't do it. Instead, take it as a reason to be cautious. I don't think private credit is mature enough, even though it's been booming for a while. I don't think it's mature enough for us to have seen all of the problems yet. And I do think there will be some. That doesn't mean you shouldn't go there if it's what you think is best for your portfolio. But you should think it's best for your portfolio. You should think you can withstand the pitfalls and get the results you want. Money Life will be right back. Welcome to the big interview on the May 22nd edition of Money Life. Returning to the show today, Steve Sosnick, Chief Strategist at Interactive Brokers, which is online at interactivebrokers.com. But if you want to really learn and get their insights, well, ibkrcampus.com is where you go to get a lot of that information. And I will point out that if you are one of our audience members who is more active, or you want to be more active, there are some very cool, interesting tools that Interactive Brokers does. They've got their traders' insight. They've got things on what traders are doing, what forecasters are doing, all this other stuff that is very cool to look at. You'll have to decide whether or not you want to trade on it for yourself. That is beyond anything I can tell you about. But Steve might be able to tell you about it. Steve Sosnick, great to have you back on Money Life.
Great to be back, Chuck. Good to see you.
Let's start with a basic take on where we are, because, you are a veteran. I've been doing this for a long time, and I don't want to say that things are normal, but we had a market that had, a big downdraft caused by a news event. It had a big bounce back. It's now at a spot where there's a bunch of headlines overhanging it. We don't really know where that's going to go. It doesn't feel like normal when we sit in our homes and talk to our neighbors and whatever, but it kind of is normal, or isn't it?
That's a great way of putting it, because superficially it is normal. It's normal for us to want stocks to go up. The normal state of affairs is that stocks go up. Over time, that's true. But what's going on underneath the hood is anything but normal. I can't think of what I'm going to call self-inflicted market wound of the magnitude that we got on Liberation Day. And I think that was made a bit worse because the president's initial comments didn't seem to care that markets were going a little haywire, considering that he was he really viewed markets as a big barometer during his first administration. He then pivoted on that one, and that is actually when markets found their bottom. But since then, the momentum fueled rally is anything but normal as well. I mean, we've only seen rallies of this type of magnitude off of lows at real market turnarounds, real market bottoms. But there's a huge difference. And I know that the most dangerous thing to say is it's different this time, but I have to point it out. Among the moves of this kind of magnitude were August of 82 or, early 2009 when we were emerging from the global financial crisis, the bounce out of COVID. Those were all accompanied by massive monetary accommodation. In August of 82, I was a summer intern, so I vaguely remember that. But what happened there was Volcker cut interest rates for the first time, from like 16 to 14, but it signaled the end of repressive monetary policy. So the market loved it. Global financial crisis, after adding all kinds of stimulus, the stimulus finally took. There were no more bankruptcies and off we went. Same thing with the COVID era when we had massive amounts. They realized that in 2020 that the 2008-2009 stimulus was probably insufficient. So we got even more monetary and fiscal stimulus. Off we went. Nothing really changed from a fiscal stimulus point of view. All we learned here was that the tariffs would have gone from truly frightening to kind of nasty. And depending on who you focus on, I've seen two different reads. One was a JP Morgan study, which I only saw secondhand, that says, okay, maybe the effective tariff rate's only going up 4%. I saw another study from Yale University that said basically it's going from like 3 to 17, and we're talking about Smoot-Hawley level tariffs, even with the new regime. That's a little difficult. And so I do think the amount of love that momentum strategies are getting and the amount of success that they're getting is in itself abnormal, despite the fact that it's doing what markets do, which is tend to perform decently over time.
That being the case, is a return or a retest of the April lows in any of your forecasts? Because I'm sure your traders have some thoughts about this.
I view it as a distinct possibility. And here's why. We're taping this on Wednesday afternoon, and the 20-year auction just sort of sent stock markets into a tizzy. I literally wrote a piece this morning: sell in May and go away, or don't short a dull tape. And it was kind of like, don't short the dull tape, but then consider selling in May next week. What got me to that thinking was after the Moody's downgrade late Friday afternoon, so Monday's trading, we saw a big opening gap lower. We saw bonds, different parts of the yield curve cross different thresholds that are considered troublesome. 2-year got above 4%, 10-year got above 4.5%, 30-year got above 5%. But as the day went on, bond traders buy dips too. So once those yields improved, I think stock traders said, well, if the bond guys aren't worried, why should we be worried about a downgrade? And stocks recovered and basically closed slightly higher. What we saw today was we came in with what I found a very odd combination of all those three thresholds being pierced and the dollar being lower. DXY was down about 0.5%, 0.6%, something like that. Then we got the 20-year auction, which priced above 5%. And then all of a sudden, everybody freaked out. This is what happens in thin markets because, again, we're sort of leading into the Memorial Day period. But it's telling me that there's some fragility. It's also telling me that while that big wave of Sell America trades is behind us, that was really early April kind of thing. I think the tide is still flowing out. And that's what the bond market move today told me is that if you've got yields higher, all things being equal, the dollar should be a bit stronger. That applies to any currency, right? You want to get a higher risk-free rate. And 2 years particularly is sort of a higher risk, that's a good proxy for risk-free rates. But all of a sudden now, the dollar selling off. And to go back to that big market bottom analogy before, we're learning from the Fed that 1 to 2 is the appropriate number of cuts. And I look at that, that's what the rhetoric has been from Fed talking heads. That's pretty much what the CME FedWatch shows. BKR forecast trader, which is a direct way for you to express opinions on this stuff, is showing about a 70% chance of rate cut by September. The markets were pricing in well more than one rate cut. So this is telling us that there's not going to be the hoped for monetary stimulus. So if this is the case, I do think it's really possible that we've come too far too fast.
Last year, everybody entered the year thinking the Fed was going to cut, or the market entered the year thinking the Fed was going to cut 5 or 6 times. They didn't. This year, my worry is that if we wind up seeing a couple of rate cuts, to convince the Fed to do it, things are going to have to be markedly worse than they are now. And that's either going to be a much weaker dollar or much higher inflation or something really impacting unemployment, which I don't see falling out of the bed the way the others could. But am I wrong about that? I mean, if you're talking about rate cuts in September, summer's going to be ugly, isn't it?
That's always my fear when the market prices in big amounts of rate cuts. That's what I wrote about in January of 24 was, we wanted to hope for not getting quite so many rate cuts. And that is what happened. The reason that it was good was we should always be rooting for a strong economy, not an economy weak enough to require massive amounts of monetary stimulus. We want an economy that doesn't need the training wheels from the Fed, that's going to go about its business and provide the revenues, earnings, cash flows, the stuff that stocks need to continue to advance. And so herein lies the problem, because we're looking at this a little differently. There's not a lot of expectations for the economy to go rip-roaring ahead. Remember also, we came into this year, we being generic we, because I don't do these kinds of, predictions, but, the market was pricing in, call it 12% earnings growth for the S&P 500. We're basically back to where we were, yet we're now pricing in about 7%. It's telling us that a lower growth environment is being priced in, fewer cuts are being priced in. And the problem is we're not taking out the cuts because the economy is strong, as we did in 2024. We're taking out the cuts because there's fear that the Fed might be a little late to the party, or that they're just going to be focused more on inflation than the economy, which that's kind of been Powell's message. That's been the message from some of the others, is if push comes to shove, if the parts of the dual mandate disagree, I think none of the Fed governors or regional presidents seem all that eager to be restoking inflationary expectations, which are quite evident in consumer sentiment numbers, by the way. And I think that's a big difference in terms of the 2024 analogy, which was, I think it was great that we didn't need that many rate cuts. Now, I think there's a different set of concerns that are preventing us from having, that are causing the rate cuts to be priced out.
When we started this, you were talking about how this is not different because, of course, you have one central event or primary event, that being the tariffs, that have caused so much of the uncertainty and that keep it rolling. Wouldn't that also suggest that the biggest danger now is reacting in any way to the tariff news? I mean, I'm not just talking about the Fed. I'm talking about individual investors in their portfolios, other than you got stress tested and, maybe you don't want to be 100% equities or whatever. Now that we're back to break even, maybe fix that. But beyond something like that, given that it is business as unusual, wouldn't that suggest we want no action until we have some certainty that, like, okay, we're going to go through some periods of tough sledding regardless. So why not have them when we have the least ability to do anything about it, as opposed to acting super early and extending the uncertainty?
That's exactly it. I think from the point of view of a central banker, you have to wait. From the point of view of an investor, I think being too reactive can be problematic. And we've seen it. We've seen everybody running to one side of the boat and then running back to the other. And that's pretty much what we've seen from a market point of view. I think your point about getting the personal stress test is crucial. I always say this after a dip. That's your chance to do a gut check. And if you were bothered by this or totally stressed or, worse, over levered or something like that, where you got margin calls, something of that nature, you better be reassessing your risk tolerance and taking risk off the table. If you went through it relatively, said, okay, you know what, markets go up, markets go down, potentially it's a buying opportunity, then your risk tolerance is different. And that was a crucial point you got to. But I think that I don't know how you don't wait and see. I mean, for example, Walmart reported last week, and their numbers were generally pretty good. I think there was a little bit of front loading. I know I bought stuff ahead of the tariffs, truthfully. But, then they said they're going to need to raise prices if tariffs go up, and the president didn't like that because, it conflicts with the message that foreigners are paying the tariffs if they have to go, if Walmart has to raise prices. And they kind of towed the line and held back. And now this week you had Home Depot and Lowe's saying that we're not going to pass it along. At least I'm guessing they're not going to say they're passing it along to avoid getting yelled at. But here's the problem for someone like Walmart, which also has a very, real premium price earnings ratio. I like Walmart as a company and as a stock, by the way, but they operate on, call it a 3% margin. Well, if you've got tariffs going up by sort of either model that I just referred to earlier, sort of whether it's 4% overall basis, or whether in the case of Walmart, which I'm going to guess is a little higher because they import so much from China, if they don't pass along some of those price increases, they're operating in the red. And so it is very much wait and see. We're going to have to see how these things get navigated. Also, to some extent, it's behooved us to wait and see because, quite frankly, the president has backed off each time things got a little too hairy, with the exception of the first week. Since then, 90 days here, I have no reason to believe that some of these 90-day moratoria won't get extended. I think that's not what he wants to do necessarily. And I think the market's kind of maybe overcompensated about that. But we can sit here for 2 hours and craft all kinds of different scenarios, which brings you right back to let's wait and see what's going on.
So because we don't have the 2 hours, much fun as that might be, let's craft scenarios that are very much based in reality right now. Because what we are seeing, we're getting to a spot where the stock market and the bond market are once again sending different messages. And historically, when we get to spots of tension, at least in my memory, when the stock and bond market disagree at points of inflection in the market, et cetera, bond market is usually the winner in that argument. That being the case, what are you reading in the differences that you're getting off of those two markets right now?
Well, I alluded to the point about bond yields creeping higher, along with a weakening dollar, which tells me that international investors are, if not fleeing U.S. bonds, they're certainly net reducing positions overall, so that we need them as a source of demand. I mean, I think we forget a lot of times that our single biggest export is our debt. We need people to buy it. That's kind of the offset of the trade deficit. So I think if we start to spook them, and I think a lot of foreigners are also getting spooked by sort of the budget talks that promised, deficit reduction, but now look to at a minimum make it no better, possibly worse. I think they're getting a little bit spooked by that. And one of my reasons for agreeing with you on the bond market tending to be right is I think bond traders are clearer eyed about this stuff. That they're not as seduced by stories. It's basically, am I going to get paid back? And if I do get paid back, am I going to get paid back in real terms that work or nominal terms that don't really work? That's pretty much their entire calculus. Yeah, there's momentum involved, whatever. But stocks get seduced by all kinds of different stories. And so as a result, that's why I think the weight of money is still bigger in the bond market. And I think that when they tend to vote, it tends to be a bigger deal longer term. A little bit slower moving, let's say. But they too, by the way, let me be clear, are prone to overshooting. You see that in long-term rates all the time. But when they disagree, when they're sending you different messages, I tend to think the bond market sends the clearer message.
Like I said, I mean, right now there are some numbers, unfortunately, like a number about the spread between the 30-year and the 10-year. And I don't really want to get too much into that because we'll lose our audience because it's too wonky. But I know that it only comes up at times like this when we're stress testing and looking and yeah, but it only comes up because it does tend to be meaningful and it's showing signs right now. There's a regime change happening.
Absolutely. I mean, we see it. We see the yield curve steepening across the board. We had a very sharply inverted yield curve, for much of 2024. And the message that the bond market was sending was wrong, was that, inverted yield curve almost always leads to a recession. And see, it hasn't, which true. And to be fair, it's not exactly like this is a high frequency data occurrence. So it occurs so infrequently that it could easily not work. But one of the things that the codicil that I found was the recessions don't start until the yield curve renormalizes. And that didn't really only occur until a couple months ago. And we're seeing the yield curve steepen fairly dramatically in the last few weeks. Still not even to the point where I would call it even normal, but that's always been the key. Is it's on there on IBKR Traders Insight somewhere. I don't have the article at my fingertips, but I've put that out there where I've shown the 2 to 10 inversions and the 3-month to 10 inversions. They tend to resolve themselves before the recession starts, which is a way of saying the market's anticipating rate cuts and potentially higher inflation coming from a more accommodative monetary policy. Thus, the yield curve normalizes again. And also recessions, there's always a bit of a lag as to when they are acknowledged, right? It's the simplest answer is 2 quarters of negative growth. So right there, it takes you a little while to acknowledge it. The NBER, who is the one who acknowledges it, I think they're a little more subtle than that, but they don't tell you this until hindsight either. So this is why I think that I don't want to lose everybody because it's much sexier to talk about stocks, but you can't ignore the bond market if you're a serious investor.
But I do want to get us back to the stock market. And I want to point out, Steve, we've had a fair number of conversations over the years.
Oh, yes.
We are 20 minutes into this conversation. You know what we haven't discussed?
NVIDIA?
We haven't discussed the potential upside of the market. We've talked about, could we retest the April lows? We've talked about what could be happening. You have mentioned that international looks good and for a couple of reasons, but we have not talked at all about upside. And there are momentum players. So at the very least, we could have some of that continues. And we have seen this nice rise. So can you give us a little something that tells us where we could be going if things are not as bad as they seem to be when the rest of this conversation?
Well, first of all, remember the old adage, right? Markets climb a wall of worry. And, I'm not going to say it's climbing an Everest of worry. Maybe we're climbing, K2 or Denali or something of that nature. But it's climbing quite the huge wall of worry, considering where we are in this conversation. Secondly, momentum can persist for a really long time. At its root, and I think we've created a generation of momentum investors, and that's not a bad thing, but there's an important thing to keep in mind when it comes to momentum. And if you are investing strictly because of price action, you are therefore saying, I don't really care what the fundamentals are telling me, right? So like in the example I gave with Walmart, if Walmart's going up because Walmart's going up, you're not paying attention to whether those margins are making the company marginally profitable or even unprofitable. If you're looking at certain tech stocks, particularly that are trading at high multiples and they're going up, I'm not going to tell you to stand in the way of that. You don't want to stand in the way of a freight train. And these momentum swings have been really dramatic and they can persist for quite some time. In the short term, you can get divorced from fundamentals because price action does justify it. But in the longer term, you can't just do that indefinitely. You can't do it forever. And so that is why, coming back to it, perhaps the market is properly optimistic that the tariff question will get resolved very favorably. Prices will not go up to the extent that the market fears. The economy can, stick around longer. You won't get job losses. The big, beautiful bill turns out to be a masterpiece. There's all these things that can go right. They all have to go right. And I think, it's a question of, is the movement that we've seen in the market now, is that the result of people seeing through all these problems, or is it just them seeing that prices are going up? Let's just jump on a trend that's working for us.
Do you or do the traders you track have the equivalent of, this is the upper limit, here's what's going to be resistance? Because we know the April lows are what everybody's worrying about being tested, and that's also support. So what's an upper limit?
This is the problem, is right now we're not really trading off of those kind of ways. I mean, I would think we've hit it, because in terms of from an earnings point of view, as I mentioned before, if we thought things were a little stretched when we were at these levels and pricing in 12% earnings growth for the S&P 500, we therefore are stretched if we're pricing in 7%. I don't know that there's a number that people have. I think we would probably get a little bit of hesitation around the old highs if we get there, and we're not very far off. that would certainly be like maybe a moment where people would reflect upon the type of, that kind of thought process about earnings and PEs and peg ratios and those kind of little niceties. But I don't know that there's a number. What I do see here is, remember, the other thing besides buying dips that's been very in favor is chasing rallies. There's the old saying, markets can remain irrational longer than you can remain solvent. And I'm not going to say that markets are irrational. That's not where I'm getting at here. But behind that, the adage I refer to is that price action can continue without regard to fundamentals. And I think that is a function of how dependent you are on momentum-based strategies. And we are extraordinarily dependent right now on momentum-based strategies. So that's how I unpack the whole thing.
You and I typically talk twice a year. This sets us up to be talking as you're getting towards year ahead outlooks and all the rest. Will we get to where we're looking at the end of the year and going, okay, this, for all the grief it gave us and for all the agita that it caused, we can kind of get to the holidays and have happy holidays? Or are we going to be going, oh man, this is miserable?
I think we got to buckle in. I just think that we went from crazy volatility to pricing in, to like we went from like a 65 to an 18 VIX, back to levels that prevailed when the markets had reason to be relatively complacent. I think, considering the volatility inherent in the lack of clarity on the monetary and the fiscal sides, which then lead to a lack of clarity in pricing. By the way, could you ever have imagined a quarter where companies left and right would say, we're going to withdraw our guidance because we have no idea what we're going to say, what we're looking at, and the market go, okay, yeah, we're fine with that. I think that catches up in 3 months, and the rubber will have to hit the road. And so that is why I say buckle in for volatility, because I think that we've been through the big bout, and remember, volatility works in both directions. So we're in the midst of this bout of volatility here. I think there's no reason to expect that we've just sort of can write it off and say, you know what, things are just going to proceed in one direction pretty calmly from here on out. That's a very tall order considering everything that's on the horizon.
Normally, Steve, when I ask a question like that, I say, hey, I'm looking forward to that next conversation already. I can't actually say that. I mean, I'm always going to look forward to chatting with you, but damn, it sounds like there's a lot of stuff that's going to suck before we chat again. But the next one will be great, but no matter how it turns out. Steve, thanks so much for spending so much time with us today on Money Life.
My pleasure, Chuck. I always enjoy our conversation. And I didn't mean to be a downer. I really was trying to be, I do think, there is a possibility that things don't go. But remember, we think about volatility being bad when it goes down. We consider it socially acceptable volatility when it goes up, but it's still volatility.
It is. And we've got a break, but remember, Steve Sosnick is Chief Strategist at Interactive Brokers. InteractiveBrokers.com, IBKRCampus.com if you're looking for more of their stuff. And speaking of stuff, well, we're going to wrap up this show, so stick around so you don't miss any stuff until we get to the finish line after this message.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
We're back to wrap up this show. We've got a lot to do, and it starts with a little mistake I made. I don't know that you could call it. I mean, it's sort of a mistake. Todd Rosenbluth talked about having made an active commodity ETF, the ETF of the week recently, and he didn't have the fund right at the tip of his tongue, and I should have been able to inject it there, and I didn't. It was the Neuberger Berman Commodity Strategy ETF. That's ticker symbol NBCM. It was the ETF of the week back on April the 10th. And if you did not know, the ETF of the week is not just part of our show. It is a standalone podcast. You can go find it in your favorite podcast app. You can either go back to our archives to find that show, or you can go to their archives. But it was the April 10th show where the ETF of the week was the Neuberger Berman Commodity Strategy. If you want to compare the active strategy to the passive strategy we talked about today. Now it's time for me to announce the winners from the contest we have been running for roughly the last week. It's our marijuana-themed contest for a chance to win Weed Empire, How I Battled Gangsters, Investment Banks, and the Department of Justice to Build the Cannabis Industry in America by Adam Bierman. who appeared on the May 16th edition of the show. To be entered into a drawing for the book, you had to tell us the name, any name of a weed-related ticker, a real marijuana-focused ETF that was a marijuana-focused name. Like, you couldn't just take the one that had initials that don't directly get you there. So we were thinking tickers like HIGH, except that's not a ticker for a marijuana fund. Neither, by the way, is dope, pot, bong, ganja, GNGA, or as Rob Floyd pointed out when we were doing the contest, CBD. We would have accepted weed, toke, MJ for Mary Jane, YOLO, all of which are real marijuana ETFs. And we got those answers and more from some of you. And our winners are Dave in Jacksonville, Florida, and Justin in Shawnee, Kansas. Congratulations, guys. You have won Weed Empire. We'll get copies sent off to you, and hopefully you'll enjoy the book. On the show tomorrow, really interesting interview for The Navigator with Brian Griggs, head of portfolio strategies for Nuveen. That'll be a fun one. More stuff coming. Yeah, there's a lot of stuff up in the air right now. As I told you, it's a crazy time on the guest book is with the holiday coming. If you're looking for something to do today, well, it's National Solitaire Day, which actually was started by Microsoft. So today's the day that it's like okay and acceptable to go ahead and use your computer to play solitaire and not feel like you're slacking, which you probably don't feel necessarily too much when you're using it the rest of the time. It is Sherlock Holmes Day, celebrating the birthday of author Arthur Conan Doyle in 1859. It is National Buy a Musical Instrument Day, National Maritime Day, and importantly, today is Bitcoin Pizza Day, which is the anniversary of the date that is generally recognized as the first time cryptocurrency was used to pay for goods. On May the 18th, 2010, Laszlo Henyets of Florida posted in the Bitcoin Talk forum offering 10,000 Bitcoins in exchange for some pizza, saying in part, I'll pay 10,000 Bitcoins for a couple of pizzas, maybe 2 large ones, so I have some left over for the next day. His call was answered, and on May 22 of 2010, he posted, I just want to report that I successfully traded 10,000 Bitcoins for pizza. A teenager named Jeremy Sturdivant sent Hanyets 2 Papa John pizzas and received 10,000 Bitcoins in return. Sturdivant paid about $25 for the pizza. The 10,000 Bitcoins he received at the time were valued at about $41, which means that Bitcoin at the time was valued at 0.41 cents, less than half a penny, less than the value of most frequent flyer miles. Today, Bitcoin is trading at roughly $110,000, meaning the Bitcoin traded for the pizzas are worth $1,110 million.
Pizza.
Yeah, that's a lot of pizza. And Sturdivant, well, he converted the Bitcoin back into dollars to pay for traveling expenses on a trip around the U.S. So, no, he's not a gazillionaire.
Now you know the rest of the story.
It's also National Vanilla Pudding Day, National Craft Distillery Day.
Beer.
Well, it could also be spirits like wine and whiskey and things. And if you don't like what you're getting from the distillery, go for International Chardonnay Day or World Paloma Day. My guests today were Todd Rosenbluth, the head of research at Vetify, online at vetify.com, and Steve Sosnick, chief strategist at Interactive Brokers, interactivebrokers.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Sukant Ratnakar, who said, losing money is not a failure. It's just one of the many events of our life which happens to lead us to a better version of our own self. Yeah, we do learn a lot through loss, and it's really good to learn those lessons and have those losses wind up becoming gains again. So be patient and understand that until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
We're here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Goodbye.